Hello everyone and welcome back to another episode. I'm joined by Josh Gilbert and Neja. Josh, how are you?
I'm very well, thank you, Sam. I'm very well. How are you, mate?
Yeah, good. Arsenal finally scored a goal. 7 of them. Can you believe it?
Like
7
London buses,
goals.
mate.
Like London buses, absolutely. But yeah, not bad. Although I went swimming on, I think it was Sunday or it's Monday it was, and I feel like I've got an eye infection from
Oh.
wearing too tight of goggles. You might be able to see it. My left eye, it feels like I've been punched by Mike Tyson. This is where I need a little bit of sympathy from all of our listeners.
You're great, mate.
Other than that, I'm okay. Neja, how are you doing?
I'm doing well, Sam. Thank you. It's getting like spring is coming, so it's more sunny, which I really enjoy, and I don't have an eye infection, which is well.
Yeah,
But we feel sorry for you, Sam.
it's also, I mean, it's blue skies right now in the UK at 8 a.m. And since Saturday, it has been exactly that. I mean, if you could give us this every March, it'd be amazing. Obviously, Josh, you're at the back end of summer now, but the weather's still probably absolutely spot on, isn't it?
Well, there is a cyclone that's about to rip through the sort of northeast of Queensland or most of Queensland. So I can't speak for sort of the northern part of Australia at the moment, but it's actually been pretty sunny here in Sydney at the moment. But I think we're going to get hit with it as well. So it's going to be windy and a bit rainy and a bit chaotic. So if you are on social media platforms, you might have seen people sort of taping their windows up and putting sandbags everywhere and that type of thing. So yeah, it's hectic.
Well, speaking of cyclones and ruining everything, Donald Trump will be something we're going to talk about with the tariffs. Joking, Donald, if you're reading or listening to this. We'll also talk about Magnificent Seven, and we'll put some drawdowns in perspective, specifically for the S&P 500. It's been an incredibly busy few days this week, and obviously 7 days since we last spoke. And I imagine in 7 days' time we'll be saying exactly the same thing. Josh, we've spoken a lot about tariffs already this year. Let's break it down and explain a little bit more about what exactly is going on.
Well, yeah, it does get a bit like that, right? And sometimes I think maybe in our very privileged positions that we're in, we maybe sometimes forget that some of the lingo that we, talk in, it doesn't sort of necessarily resonate with everyone all the time. We do very much try to do that. But even in just this very simple step, I was having a conversation with someone in our office the other day, and she just said, what's a tariff? What is it, And I just thought, it's a good point to maybe try and strip it back a little bit, because Donald Trump's only been in the White House for a couple of months, but he is causing a bit of a stir. And the biggest move so far, is we've sort of covered, and if you do follow markets, you would have known that, in the last couple of days, Trump has made good on the promises, or even threats, but they are now promises. And he's put sort of 25% tariffs on imports from Canada and Mexico, and he's doubled up tariffs from 10% to 20% on Chinese goods. The reason why this is important is that these are the three largest trading partners to the United States. So really, really important. And together they account for about 40% of US imports in 2024. We've seen a bit of retaliation. Canada and China have both retaliated with basically a bit of pushback on US goods. That sort of only has escalated tensions and sort of fueled fears of a broader trade war. For Trump himself, he's using this as a bit of a strong arm. He's looking to sort of try and get what he wants. It's his economic strategy. But he also argues that it's sort of protecting American manufacturing. It's creating jobs. It's raising tax revenue and sort of rebalancing the trade deficits. And I hear you both screaming, what on earth are tariffs, Josh? Well, I'm glad you both asked, because essentially tariffs are very simply taxes paid by companies importing goods, in this case, into the United States. They're calculated as essentially a percentage of the product's value and are designed to protect domestic industries by making foreign goods more expensive. As we know, Donald Trump is America first. So an example of that, the 20% tariffs that we're seeing on China, if you're importing a $10 Chinese-made item, it's going to cost you $2 more. That focus then shifts to the importers. Do they take a hit to their profit margins, or are they passing that on to consumers through higher prices? Either way, it doesn't really matter, because the ripple effect is that it's going to be higher costs for businesses, potential price hikes for shoppers, all of us, and then it's that scramble to adapt to supply chains. But for some context, this isn't the first time we've been here. Donald Trump, as we know, has had a previous stint in the White House, and he then also provoked a bit of a trade war. So in 2018, Trump also introduced tariffs on China, and that trade war lingered throughout the year. Look, I won't go through all the finer details there, but we saw multiple pullbacks and corrections for the S&P 500 from 2018 to 2019. But by the final months of 2019, the worst of the trade war sort of volatility had begun to subside. The S&P 500 finished the year up 29%. It rallied 16% the following year, and then almost 27% the year after. So in hindsight, if we look at that, the last trade war, the sort of impacts came in waves, and that's exactly what we've seen here recently. The start of this year, we've had that sort of initial impact. We've had market rallies, and now we're sort of seeing the impact again. Again, those sort of escalations have triggered sharp sell-offs, surges in volatility, but then at the same time, back in 2018, each truce, each trade deal sort of sparked relief rallies. So I think, again, it's going to be something that sticks around. This is going to be a key driver of volatility. It's going to cause pullbacks. But it's important to remember, back in those sort of periods, it was short-lived, and markets ultimately bounce back. And I won't go too much into the drawdowns perspective because I know that we'll cover that a little bit in a moment. But the worry is that Trump here is going to sort of ignite a full-blown trade war, and that ripples across all of the world, right? And it affects earnings, it affects growth. Even just a simple one, looking at car manufacturing, where, ultimately in the US, parts, they go through the US, they go through Mexico, they go through Canada, they sort of go through these borders so many times. So that's especially vulnerable. Uncertainty here is the key driver. So that's, the big thing. We just don't know. So for me, keep a close eye on those trade negotiations, tariff announcements. If these escalation of trade tensions pick up, if we see new tariffs or a breakdown in talks, we could see more market volatility, and we might even see more downside. But on the other side of that, if we see any easing of tensions, rollbacks on these tariffs, trade deals, that may lift like this sort of cloud and a little bit of uncertainty, and it will spark relief rallies as well. We saw this during the last trade war, as I said, during 2018 and 2019. So again, zoom out, look at the bigger picture here. We've been here before. This isn't something new. That's the tariffs in short, and ultimately it's probably not something to sort of run for the hills for.
Yeah, that's definitely true, because I think that the market is the most worried about the unpredictability. We are going with the tariffs, and then we pause them, and it is changing day after day. And you really made a nice overview of what happened in the past few days. But in the end, the market is also worried how the tariffs would affect inflation overall, and how they would affect customers. Just yesterday, I saw that New York Fed President John Williams had a speech about tariffs, and he commented on tariffs as well. And it was kind of interesting. He said that he sees tariffs as inflation risk, but there is still lots of uncertainty about their full impact. They kind of expect that we will see effect on consumer goods to push prices higher quickly, and that could also impact inflation. But I think that the Fed overall so far is like they are performing a very good job. So there is not so much to worry about, at least not on the short term. But of course, this unpredictability is causing all this volatility right now.
I think unpredictable is the word, isn't it? And it really does remind me of last time in many ways, and especially for intraday or even swing traders that may have a position on that completely meets their edge. It's the setup is A1 for them, whatever that might be. You're in the trade and it's going well, and it's just one headline that can turn things around. And if you go back 3, 4, 5 months and beyond, that's quite rare that throughout a trading day, just a random unscheduled headline is going to drop and the market's going to turn on a sixpence. Whereas that almost seems like it's happening multiple times a day now, with we're going to do this, or we're going to retaliate this way, or this country's doing this. And it is very hard for some people who are really good reactionary fundamental day traders. What an opportunity. This is your bread and butter. For those that aren't really into all of that, it's tough. And there is no harm in saying, you know what, I'm just going to take a step back for the next few weeks or months or whatever it might be, or really, sort of lower my risk, because the ranges in the markets now are a lot bigger than what they were, just a few months ago. So it is tough out there. It really is. But Josh, I'll give you 10 out of 10 for your explanation now for tariffs. And I don't want anyone listening to this saying they don't know what they are, because you've just been told. Nezha, let's move on to the Magnificent Seven. And obviously they played a crucial role in the last few years of driving a lot of the S&P 500's growth. In fact, those seven companies have accounted for over 50% of the index's gains in 2024. However, this year tells a bit of a different story, with the group experiencing quite notable underperformance. What do you think is behind this shift that we're seeing?
I mean, I decided to cover this topic because I don't want to focus just on one company, because those 7 companies were really the backbone of SP 500 massive gains in 2024. And it's so strange to see them struggling this year, because nevertheless, they make up like 1/3 of SP 500. And with that, they have a major impact on index performance, obviously. And since they are not performing that well recently, they dragged the index down and they erased all gains that the index made since US presidential elections. And I actually checked yesterday if there would be an ETF, equal weight ETF of those 7 companies. So Meta, Microsoft, Tesla, Apple, Amazon, and Nvidia. Its year-to-date performance would be approximately minus 11%. So we really see that they are underperforming this year. And talking about the reasons behind that, I would say that one of them is obviously valuation concerns, because high valuations demand extraordinary growth. And we have seen that even better than expected earnings are simply just not good enough anymore. Because we saw Nvidia having a blowout quarter, and the market basically met it with sharp decline. And it's important to note that this is not because the company is failing, not at all. It's just because that expectations were simply too high. And if we take a look at other companies in the group as well, Tesla is struggling the most among them. It is down about 30% year to date. And there is slowing EV demand, growing competition, especially from China, and all of that puts more pressure on the stock. Then we had Microsoft and Alphabet earnings, which were solid, basically. But the market was concerned just on the slowing cloud growth, which spooked investors and caused a decline. Then we also had Amazon, which also saw a decline. And Apple, we already covered Apple in one of our previous episodes, how they're struggling with slowing iPhone sales in China. We saw some better news about AI recently, which helped them, but they're still down year to date. And I would say that the only bright spot right now in the group is Meta, which is the only company that is up year to date, and it is up like 6%, I think. And recently they even had this 20-day winning streak, showing that investors are still rewarding them and they see a potential in them. But you never know what's going to happen on a short term. So it's been a tough stretch for Magnificent Seven, and it seems like market is rotating from these big tech companies. But we can't say that they don't have strong fundamentals anymore. Not at all. It's just like short-term volatility, high valuations, high expectations, and this volatility and unpredictability are one of the key subjects in the last few days. And it seems like we are really seeing some rotation from big tech. But nevertheless, I would say that if investors are invested in those companies on the long term, they should just zoom out and not freak out at the moment, because it's just a stress that is not needed at the time. We saw pullbacks in the past as well. But I don't know, what do you guys think? Is this just a temporary rotation from big tech, or are we witnessing a broader shift from mega cap dominance?
Yeah, it's a great point. And you made the key point there was talking about valuations, right? They were priced to perfection, weren't they? I had a quick look today, and the Magnificent Seven at the end of February were trading at 36 times forward earnings. Now they're at about sort of 26 times. So it's a big shift in sort of multiple. within sort of, a week, basically, in terms of that sell-off and that drawdown that we've seen from the Mag 7 so far this year. And I think the interesting part for me as well is that in the last couple of years, a lot of sort of market commentators have sort of been calling for that rotation out of the Mag 7. They won't perform as well this year. They won't continue to perform. I think it's something that we've said here that, we think that they're sort of the market staples. They'll keep sort of doing well. But a lot of commentators have said, no, there's no rotation out of that. But they sort of continue to sort of outperform. And as you said, Neza in 2024 drove that sort of S&P 500 far, far higher. So look, even if we do sort of see, that sort of slight rotation into sort of some of those cheaper, areas of the market, and even sort of the more defensive areas of the market, right? Given the uncertainty that we're seeing, yeah, okay, fair enough. But I don't think we're probably really going to see the end of this sort of big tech ride here. This is going to sort of continue. These are the names that are dominating. Nvidia is the best in the business. These are the cloud names, the hyperscalers. They're all spending more money than ever. They're going to keep growing. So I think it's short term. I think it's temporary. We will see that sort of, move into sort of cheaper areas of the market, especially when we get that uncertainty. Investors are looking for, a bit of certainty. But yeah, this isn't something that I think is going to last forever.
Yeah, I'm with you. And I also think, in the near term, potentially now for one or two of those companies you've mentioned in the Magnificent Seven, your Teslas, your Nvidias, there's going to come a point for some people where the valuation just makes sense, or the technical drop that you've seen just makes sense for a long-term investor to add to a position, or dollar cost average, or get in for the first time. It makes sense for the little rotation plays that we've seen, this year. And if you had unwound positions at the back end of last year and gone into EU defence stocks, you'd be laughing right now, wouldn't you? You'd also look like a bit of a genius for predicting exactly how that's going to go. But, there has been, I guess, looking back in hindsight with 2020 vision, some good opportunities to allocate capital better. That said, there's going to be an opportunity coming up, I imagine, where these unbelievable companies are just going to be at valuations that people will want to have a little bit of a nibble at. That's the way I see it anyway.
Yeah, I think it totally makes sense. And for investors that might not want to invest in something so concentrated as SP 500, there is still equal weight as S&P ETFs options. So there are other options to invest in the stock market if you want to avoid this concentration right now. But talking about SP 500, we just had our 30th 5% dropped in the SP 500 since 2009. And this might be scary for some investors. Are there any ways to look at the situation more positively?
Yeah, on the face of it, it doesn't seem too pretty at all. And I remember the first time I invested in markets and we moved lower, and you do panic. You do think, God, I need to sell now. This is going against me. And I think that's completely normal. I think perspective and experience helps a lot. So I think that's the idea of this section of the podcast. Just to go through a few of the reasons behind the most recent 5% or more pullbacks. We'll put this one down to tariff fears and economic slowdown concerns. And I'm not saying it's only going to stop here. It did actually hit the 200-day moving average last night before bouncing a little bit. But that's obviously, I think, the first time in about 18 months or so, maybe a little bit less. But last time it hit that, it did rally significantly. So that's a good line of defense for the bulls to defend and the bears to try and break. Before that, we go to 2024, July to August, a few sort of couple of weeks, recession fears. Fed behind the curve, the Nikkei crashed. You'll remember that on the Monday, where the Bank of Japan were hawkish on the Friday and the market fell out of bed, and we covered straight away. But on that Monday, I remember we talked about the podcast. We had all mates messaging us, being like, what's going on? And it turned out it was a good time to go shopping. Another one in 2024 in March, stubborn inflation, Fed pushing back rate cuts, geopolitical conflicts. And then you go to 2022, and it was a bigger decline, 27%. By the end of it, and that was down to inflation, rising rates, Fed tightening, geopolitical situations, recession fears. But there's a really good tweet, and I'll pop the link in the bio, which just sort of goes through all of those 5% or more corrections since the March 2009 low, and just puts it in a little bit of perspective. At the time, it does feel like, everything's going to keep falling here, but it doesn't. And also for those that are completely new to investing, I'll reel off a couple of stats. The S&P 500 total returns is positive 62% of the time on a 1 month period, 75% on a year period. If you go to 5 years, 89% of the time. And if you go 10 years, 94%. And if you were to go and hold for 20, 30 years, no one in the history of investing in the S&P 500 has ever lost money. So it's a really good one, that, isn't it? It's never been lower 20 years ago than where it is now. But also we always have drops. You know, if you had invested $500 a month in the S&P 500 in the last 40 years, you would have lost at least 10% 15 times. But today you would have 3 million. And that's just doing $500 a month. It's incredible, isn't it? But multiple over 10% drops just in the last 40 years. And again, at the time, they all seemed really, scary about what an opportunity they would have been to get involved. And the average intra-year S&P 500 decline is 12%. So again, not that unusual. And also, we had a great year last year, albeit sort of stumbled over the line, didn't it? But we haven't had more than 2 down years in a row since 2002, where we had 3, 2001, 2002. So the S&P 500 has been on a real tear and has averaged 11.6 annual return since 1985. So over those last 40 years, it's been a monster. It's just been incredible. So a breather is healthy. Breathers are expected. And I think that can help to put things in a little bit of perspective. That isn't me sitting here saying we've now found the low just because I've talked about it. But it does make, I think, people feel a little bit more confident knowing history is on their side and that more often than not, things are going to recover relatively quickly.
Yeah, you made a great point then and just said that it's a healthy correction, right? We can't just keep going up in a straight line forever. It's tough. It's never nice opening up those the portfolio multiple days in a row and seeing red and sort of wanting to see the green. But we had a lot of green for a long time.
We did.
There were periods there where I was opening up the portfolio saying, how long can this continue for? And it stopped. Yes. So we've got that. Look, and I think that it sort of does highlight the importance of diversification, right? Because if you have a look at Europe right now, Europe is outperforming. Just looking on Bloomberg today and just, conversely looking at the different performance, all of European indexes are pretty much in the green for the year. So I think in times of, market turbulence, not all sectors, market, geographical locations react the same way. So I think that's really important. So, if you're diversifying, it smooths out that volatility in a portfolio. And that's sort of really important. And I think, another key point to make is we're not sort of saying that right now this is the worst it's going to get because volatility might pick up further, right? The VIX is nowhere near where it has been in previous times. We go back to the carry trade, right? That was sort of some of the highest volatility we've ever seen in markets. So volatility might increase further and the sell-off may deepen. But that's still not a reason to sort of necessarily run for the hills. We're still not sort of, anything out of the ordinary yet. I think we're only sort of down we're down less than 10% from the highs. So completely normal. So if you're a long-time investor, you may find opportunities arising to own quality companies at far more attractive prices. But I think it's about being astute, right? Sam, you mentioned it last week. It's the only, the stock market from a mental perspective is the only place in the world where people run from lower prices, right? You got to think of it like Black Friday. They only appear every so often. It's frustrating when you already, let's just say you already own the discounted item, you already own Nvidia, but now it's, 20% lower than it was when you bought it a month ago. So it's maybe an exciting opportunity. They put it on sale. That's maybe a way to think about it. Again, we know that past performance isn't going to give us that guide to the future performance, but it's a good way to try and look at it, and zooming out is really important perspective.
Yeah, zooming out is really a good perspective. It's just hard to invest because no one knows when will be the bottom of this correction. But nevertheless, there is a strategy that investors can use, and that is just dollar cost averaging and investing more in companies with solid fundamentals. As you said, Josh, Nvidia got 20% cheaper. And if you already believe in the company, you can just take a look at it as a discount, not like a scary event, but as a discount on the market and take advantage of this opportunity, basically. Because maybe we will be looking at this event in few months' time and we will be like, oh, I wish I would invest more at the time. Like,
Yeah. Yeah, and actually, I was just looking while you were talking there at the number of days for each of these correction periods, right? So going back to these 30 since the March 2009 low, there's been 1, 2, 3, so 27 no, 3 yes, where the correction period has been over 100 days. 27 are under. Basically, 27 are less than 3 months, which is incredible, really. They happen quickly. You know, you may have heard the saying, stairs up, elevator down, and that's usually what happens in these periods. But it's not like it's going to last forever, and I think that's also important. So,
and there's also a stat, isn't there, as well, like the best days in markets, or a number of the best days in markets happen after the worst days, right? So it's about sort of staying invested, and if you jump out, then you miss those good days as well, and it can very, very heavily impact your sort of overall performance as well if you're just not invested.
Yeah, it really can. On that note, we'll wrap it up. But as usual, Josh, Neja, thank you very much, and see you all next week after another crazy 7 days, I'm very sure.
See you guys.
Thanks, guys. See ya.